the rotation is all about. This week, we got a flattish dollar. It didn't really move one way or the other in a significant way, but we've seen a drop in bond yields. Now, when that happens, we have to ask a good question, which is, was the drop in bond yields for good reasons or bad reasons? Good reasons meaning the Fed is going to cut rates because inflation is coming down. Bad reasons, we're cutting rates because we're getting recessionary data. Well, if that was the case, then we should have seen the dollar also going down as we begin to price in a recession and more intervention by the Fed. But the fact was the dollar is flattish, bond yields are down. And the other piece of evidence was if you look at the 2-year yield in white and then the 30-year yield in orange, you can see that the 2-year, which is the pulse for the Fed policy, they have more control over the shorter end of the yield curve, not the longer meaning 10 to the 30. So when you see the 2 moving down by a bigger magnitude than 30, it shows you right away, and we go back to the month of July for illustration purposes. You can see that the 2 years down almost 8%, the 30-year yield is down about 3 to 4%. That tells us right away that we have a steepening of the yield curve. It's happening because folks are thinking that, hey, the Fed is going to cut rates for the good reasons. They're done with inflation, they're going to begin cutting rates. If that is the thinking, of course it's going to benefit what? The risk-on rotation, IWM, KRE, regional banks, the profitless companies, you know the deal. But it also benefits the risk-off rotation. As bond yields go down, it appreciates the value / the dividend-paying companies. But of course, these rotations happen at the expense of the AI mania. Not because, now that you thought about it a little bit, not because we're moving the money, the $2 trillion that we took out of the AI into the risk-on or risk-off rotation. No. A lot of that money is staying in cash. A lot of that money is just transferring hands. But what's happening right now is the thinking of, well, we got the first hints that the Fed is about to pause. And we've seen the top in bond yields and the dollar, and then we've seen a pause. They stuck at a certain level, way too high for a lot of sectors of the economy. The thinking was that the companies who can withstand this high level of rates, even though the Fed is pausing, not hiking, would be the large cap companies with a lot of cash in the books. The Mag 7, the AI mania. If we have a different dynamic now, with yields going down, and perhaps the dollar also going down, then the thinking goes, maybe we've overdone it with the inflows into the big caps and the AI mania. We need to take that out and then rotate some of that money into the newer trade, the fresher trade of risk-on rotation or risk-off rotation, depending on what you see in your economic outlook. So that's what's really going on. The question now becomes, where do we go from here? We have a critical week coming, folks. We have the FOMC. Whatever the Fed does will have an impact. Now, the consensus is the Fed is not going to cut rates in July. The Fed will wait till September. Frankly speaking, I want the Fed to cut rates next week. Not because I think, the economy is falling apart and the Fed has to cut to rescue the economy and all of that. But I want folks to see the duality of the risk. I want them to see, because there's talk, of course, that, hey, Fed, you got to cut rates right now because if you don't do it right now, the economy will deteriorate even more. So this is the sweet spot to do it. And that talk, of course, comes from a lot of perma pumpers. But seldom in the conversation the talk of what happens in the duality of the risk. That if you address one risk, which is the recession risk, what happens to the inflation risk? I want folks to see that. I want them to see that the moment the Fed begins cutting rates, you'll see inflation moving back up. That's why I want the Fed to cut rates this coming week. But regarding the stock market activities, the tone and the narrative really matters. Is the Fed cutting rates because of fear of recession, or are they cutting rates because inflation has been defeated, mission accomplished? It makes a lot of difference, because if you look at fear of recession, we have plenty of evidence to that. For example, if you looked at any earnings from consumer-related companies, these were awful. I mean, you look at Tesla, it dropped down 45% net income year on year. It shows that the market is oversaturated and the consumer is getting weaker to buy new EVs, and the confirmation came from GM and Ford. I mean, you look at Ford, the biggest drop since 2008, because these EVs, not reliable, cost a lot of money, and folks don't have the spending power to buy these EVs. It's not just EVs, folks. You look at Southwest, profit down 46%. You look at Capital One, profit down 61%. You look at UPS, the biggest drop in the company's history, because package volumes down, revenues down, expenses up, consumer getting weaker. But inflation is sticking. We have stagflation in the economy, and it's impacting these companies. Even the affluent consumer, we got warnings from Burberry before, but now even Gucci, hitting 7-year low after a weak forecast. They say because of drop on China sales. We all got it. China's weaker right now. It is already in a recession. But the weakness is also showing up in other territories. The consumer is getting weaker here, in Europe, all over the place. And because of stagflation, we got the news this Friday that U.S. consumer sentiment falls to 8-month low on high prices. So there is evidence if the Fed wants to cut rates because of fear of recession, there is evidence that they can do that. And even somebody like Bill Dudley, who I would consider a rational former member of the Fed, you got to remember he kept saying that the Fed is not doing enough, they should hike rates more, yada, yada, yada. Now he flip-flopped all of a sudden, and it made headlines in the market this week. He said even September may be too late for a rate cut to swing the U.S. economy out of a recession. As if Bill Dudley saying, look, based on the evidence that we got so far, we're heading into a recession, no doubt about it. And if the Fed cuts rates by September, it'll be too late. As if he's suggesting that the Fed should do it now in this upcoming meeting. So suppose that happens. Suppose the Fed cuts rates because fear of recession. Of course, the Fed is not going to tell you, hey, we're cutting rates because we're afraid of a recession. Not going to say that. But the market will read between lines in the statements in the conference. If it comes out with this conclusion that the Fed is cutting rates because of fear of recession, what do you think will happen to the dollar and bond yields? They'll go down because the Fed is easing policy now. But when it comes to the rotation, the risk-on rotation, the IWM, the profitless companies, the regional banks, would actually reverse and trend down, because we're cutting rates for the wrong reasons. On the other hand, the risk-off rotation, the dividend-paying, the value stocks could actually gain momentum from that point on, because with yields going down, even if it is for the wrong reasons, so long as we're not buying bonds and the dollar together, meaning dollar and bond yields go down together, then money has to go somewhere within the market, and it will favor the value/dividend-paying stocks. Now, suppose the Fed cuts rates this meeting, but the market reads it as, oh, they're cutting rates because they're confident that they have defeated inflation. Then what happens? Dollar continues to go down, bond yields continue to go down. It'll be good for the rotation, doesn't matter which one you choose. But of course, it'll be more favorable toward the risk-on rotation. The RWM will make a higher high, the KRE regional banks will do the same, the home builders, the real estate sector, the biotech sector, the retail sector, because everybody will assume that, okay, the worst in the economy is already behind us, and the Fed will cut rates, this is going to be good for the economy. What happens, though, which is at least right now the consensus, that the Fed hold rates and they don't cut. The question now becomes, and they're kind of correlated, but it makes a bit of difference. Are they holding rates because they need to see more? They need to see another positive, in other words, negative inflation reading? Because if we got negative inflation reading, that means it's positive for the Fed and for the economy, that inflation is going down. Or are they holding rates because they're afraid that if they cut, inflation will come back up? That the inflation risk is not defeated quite yet. Again, they're kind of similar, but they make a difference. Need to see more is a little more positive than, oh, we're worried about inflation risk. In any case, the impact will pretty much be the same. The dollar and bond yields will rebound higher because right now we've already priced in a rate cut, a 25 basis points rate cut. If that's not going to happen in July, you'll see the dollar and bond yields going higher. Is there a case that the Fed will hold rates? Absolutely. And it comes from Vanguard, the biggest one of them all. Vanguard offers unexpected Fed interest rate forecast. This was shocking because everybody said, oh, the Fed is going to cut rates, no doubt about it. If it's not July, it's September. Vanguard disagrees. Economists at Vanguard see things a bit differently. They anticipate the Fed will leave its federal funds rate target of 5.25% to 5.5% through year end. That is unchanged from the prior forecast. The Fed funds rate is charged on overnight interbank loans. Continued economic growth, labor momentum, and stubborn inflation are likely to leave the Fed without the confidence it needs to cut rates this year. The economists from Vanguard wrote in the commentary. So again, there is a case that the Fed is not going to do it in July, and they might say that, hey, we need to see more before we do September. If that is the case, again, we know the dollar and bond yields will go higher. That's going to be bad for any rotation, risk off or risk on, but specifically the risk on. The IWM, KRE, XHB, all of these rate-sensitive ETFs and stocks will go down tremendously. They will pull back in a big way. The risk-off rotation will give up some ground and pull back too, because now bond yields are going higher. The question now becomes, where would the money go in that scenario if the rotation is not working out? It depends on tech earnings. So we have plenty of them coming out this week. If we have a savior, and by the way, Alphabet earnings were pretty good, but the problem is we see peak in the bottom line, peak in the growth in revenue, and the stock price already priced in a romanticized story, an AI story. And all of a sudden the earnings report comes out good, but says, hey, the stock price doesn't make sense. So there is a correction. The question now becomes, do we have earnings from Apple or Meta or Amazon, any savior that can come out and say, look, we have growth and growth is still going on? It's not peaking, it's not stalling. If that is the case, then tech earnings will come out good, and we will see a rotation to AI/big cap tech. We'll see buying the dip with these names. If tech earnings come out bad, though, then in that scenario, we have a rotation to the dumpster. Everything gets sold off. The other challenge, of course, that comes after the FOMC, not this upcoming week, but the week after. I've said this before repeatedly in this program, that we're going to have a day just like Black Friday back in the year 2000. But the NASDAQ went down by more than 10% in a single day. And the catalyst behind that was a not-so-friendly inflation reading that told us, hey, wait a minute here, the Fed is not going to cut rates. And I think we'll have one of those. Now, is it going to come after a Fed rate cut in July, or will it come out after a Fed hold? Makes a difference, but we're not going to go ahead of ourselves here. But just keep that in mind, that the CPI next reading will be really important. If there's a rebound in inflation, it's going to change a lot of things, and we might see a shock kind of reaction in the market. But one step at a time. This week, we only have the FOMC as the most immediate catalyst. But we just played and gamed some scenarios on how the rotation works out. Now, the other thing I want to show you is a lot of folks brought this up to my attention. Hey, what do you think about the rotation to international equities? Since American equities has been